What's up, you guys? Boris here with another episode of Finance Talk. Thanks for tuning in, you guys. I am an active real estate investor. I'm a landlord. I have my real estate license. I like to also dabble with equities. I love the markets, stock market. I like to trade credit spreads, derivatives. That's anything having to do with finance, you guys, is my passion. I am a straight up finance nerd, and there's no shame in my game. I am a nerd, you guys. I read the tax code for fun. I call it my CPA on speed dial, like, all the time, man. The guy's like, this guy again. Listen, that's who I am, you guys. And I'd like to talk about finance, you guys. So if you guys appreciate the content, I've been working hard to put this out. If you guys appreciate the content, please like, subscribe, hit the thumbs up button, you guys. I appreciate all the support. So today, you guys, we're talking about Cathy Wood, ARK Invest. If you guys, everybody knows who Cathy Wood is. Her ETF is blowing up. She targets disruptive technology. Her strategy is growth plays as opposed to value plays. So a value play would be like an Apple, an Amazon. Those are conservative, reliable plays that often pay a dividend, as opposed to a growth strategy. These are companies in their infancy. You want to capture them. They're the new kids on the block. You want to capture them in their infancy. And she's done phenomenally well. Her strategy has outperformed the markets. The markets are selling off. And the greatest victim to the sell-off is the quintessential growth play, Cathy Wood's ARK Invest ETF. She's seen record outflows. Her ETF has dropped to the tune of 25%. And the reason the markets are selling off are due to inflationary fears, you guys. Basically, we have another $1.9 trillion stimulus package about to pass Congress, Senate. They're going to flood the marketplace. That's in addition to stimulus package number 1. Number 2, this is now stimulus package number 3. That's about to flood, more liquidity about to flood our marketplace. Sounds familiar to the 2008 subprime mortgage crisis when we had quantitative easing 1, 2, 3, quantitative easing into perpetuity. Basically, we're seeing more liquidity flood the marketplace, just like we did in the subprime mortgage crisis. So there's inflationary fears due to all this liquidity flooding the marketplace. In addition to additional reasons for inflationary fears is the reopening trade. There's a lot of consumers sitting on the sidelines. They aren't spending money because the traditional brick and mortars are closed. Once we have the full reopening, people are going to begin to shop again. That's additional liquidity being injected into the marketplaces. And also another factor are Treasury yields. What's taking place in Treasury yields, you guys? I'm certain you guys have been hearing it on the news. The Treasury yield is spiking. But what's taking place with the Treasury yields? What's happening, you guys? Well, basically, in order for the federal government to fund the latest stimulus package, they need to come up with the funding somehow. So what they're doing is they're selling more Treasuries. They're basically flooding the marketplace with Treasuries. And if you guys understand supply and demand, as you have more supply, the marketplace for treasuries, as you have more supply in the marketplace, the price is coming down and the yield is inversely correlated to the prices. So as the bond prices come down, the bond yields increase. A lot of investors are now taking notice of this. And they've been speculating. There's in fact record short interest in the bond market right now. There's more volatility now in the bond markets than there is in the equities markets. And this is just unprecedented. And it's kind of causing chaos, right? It's also not good for the real estate market, you guys, which is kind of like a tertiary effect. But the 30-year mortgage closely follows the 10-year Treasury bond. The yields are spiking, so are mortgage rates spiking as a result. So everybody's saying interest rates are spiking, interest rates are going up. However, it's not the Fed causing this interest rate. It's speculation in the markets. And I think the speculation will probably cool off and we'll kind of return to equilibrium. And Cathy Wood is of the same opinion, basically, you guys. She recently put out a video, and I want to go ahead and play this video, you guys. There's like great content, you guys. She's a really smart woman, and I really admire her. Let's watch this video, you guys. I'm gonna analyze it with you guys.
See that the Fed is nothing but supportive. And we see M2 growth still up in the mid-20s. Very rapid rate of growth, so very supportive monetary policy, and the chairman emphasized once again that they're focused on two things: full employment, and we are far away from that, and then inflation above 2% and consistently above 2% on a year-over-year basis. We are not there yet. We're in the 1.5% to 2% range. So nothing right now suggests that the Fed is going to tighten, except for maybe the markets themselves. And we see other indicators perhaps calling for some changes at the Fed in terms of tightening up monetary policy. We see commodity prices really moving up very rapidly, especially copper, and especially copper relative to gold. So copper is the commodity with the PhD, as many people often say, and gold is more of the safe haven or inflation hedge. So to see copper going up that rapidly against gold suggests there are animal spirits out there. The dollar is going down. Housing prices are moving up at a double-digit rate, which is pretty astonishing. We've seen very strong asset market prices when it comes to stocks generally. We're still up for the year, even after the recent turmoil. And of course, we've seen action in the cryptocurrency space, pretty dramatic action. And yet the Fed is not responding to any of those, not yet at least.
Not yet, at least. Cathy Wood is stating that the Fed is not tightening their monetary policy. Not yet, at least. The Fed targets a 2% inflationary rate. And the Fed has stated on numerous occasions they feel that these inflationary fears are not warranted. Cathy Wood is acknowledging certain asset classes, particularly equities, the stock market, are inflated. However, the Fed is not concerned primarily with only equities markets. They're concerned with consumer prices. How much is a gallon of milk when you go to the grocery store? In terms of the crypto space, cryptocurrencies, Cathy Wood feels that cryptos are a bit inflated currently. Cryptocurrencies is basically a digital storage of gold. If you're fearful of inflation, then you purchase gold as opposed to holding your currency in US dollars to hedge to hedge inflationary dollars. Cathy Woods feels that cryptos are inflated because we aren't truly heading into an inflationary marketplace. Therefore, she feels the speculation in cryptocurrencies as a hedge against inflation is not warranted, it's not legitimate.
The quantitative easing was on its way out, and the Fed was going to start raising interest rates. They had telegraphed that, and the market was very nervous. And I remember one of the reasons it was very nervous was after President Trump won the election, the odds of a cyclical burst increased because of his promise to cut taxes. And that's exactly what happened. But in the beginning, the equity market responded, was very nervous around this idea that interest rates would be going up. And what happened is when President Trump was elected, value stocks took off. Just like they're taking off now, responding to this idea that this economy is developing ahead of steam. So the value stocks have taken off. Traditional value stocks are having a nice run here. And how do we feel about that? We feel really good about that. Just like we did in 2016, when we said value is up, and actually the market was up, value up even more, and growth strategies like ours were down. They were actually in negative territory back then. And I remember saying at the time, I think this is great. I think it's great because the bull market is broadening out to other sectors. And that can only be a good thing for us. What would be very negative for innovation-based strategies is if the market continued to narrow so that only innovation strategies worked, because that's what happened during the tech and telecom bubble, and we all know how that ended. There was too much capital chasing too few opportunities back then, too soon. Um, so I actually like the fear that we have experienced. I like it, and mostly because I don't think it'll last. But I'm happy that there's a reality check in terms of the speculative moves that have taken place within the innovation space. Now, what happened after the fourth quarter of 16, after the market had broadened out, was 2017 was a fantastic year for the equity market generally, both cyclical value and growth.
Cathy Wood is finding parallels to today's markets to the marketplace following Trump's election in 2017. Markets were selling off, quantitative easing was ending, and rates were going on the way up. Value plays are performing well. Your Procter & Gamble's, your Anheuser-Busch, your consumer staples, your financials, and your industrials. They were performing well. Your growth stocks were selling off. Your disruptive tech, as Cathy Wood likes to call it. She calls this a broadening of the bull market. She says this is beneficial. Unlike the tech bubble, where too much funding was chasing too few assets. It was too much concentration, which fed into a bubble. She feels that our equities markets is a little bit of a bubble right now. She feels it's healthy to correct this right now. And she feels like this correction will be short-lived. And this broadening of the bull market is very healthy. And this will now feed into the next stage of a bull market.